Take a look at this projection. Between 2026 and 2031, the largest technology companies on Earth are on track to spend up to $7.6 trillion on artificial intelligence. This capital is buying physical infrastructure at an industrial scale. We are talking about hundreds of thousands of specialized compute chips, massive new data centers with industrial liquid cooling, and entirely new power grids to keep them running. To fund a build-out of this size, tech companies are abandoning their usual strategy of relying solely on their own cash reserves. Instead, they are turning to the debt markets, issuing over $200 billion in investment-grade bonds to finance the expansion. Hyperscalers, the massive cloud computing providers, are taking on so much debt that they are now using physical H100 GPU chips as collateral for multi-billion-dollar loans. They are financing mountains of hardware before a definitive, highly profitable consumer application for AI even exists. You will hear endless debates about whether AI is overhyped or if the models are hitting a wall, but evaluating the technology itself is the wrong way to figure out if we are in a bubble. To see what happens next, you have to follow the money. In the 1700s, Adam Smith outlined a basic economic principle that modern analysts call the capital cycle theory. It focuses purely on the supply side of an industry. The cycle begins with a new technology showing the promise of high returns. That perceived opportunity acts as a magnet, and massive amounts of capital blindly rush in to chase the profits. But this sudden flood of money triggers a supply-side arms race. Companies overbuild to capture market share, which creates an enormous oversupply of infrastructure, naturally driving future profit margins straight into the ground for everyone involved. The biggest financial disasters rarely start with a bad product. They happen because an entire industry collectively misjudges supply and demand, leading to catastrophic overinvestment in the underlying hardware. This initial phase is the boom. It is defined by a debt-fueled frenzy to construct physical networks and facilities that the broader economy simply isn't ready to use yet. In the 1840s, the global railway mania saw corporations issue colossal amounts of debt. They borrowed against their tracks, their rolling stock, and even their federal land grants to build routes across the American frontier. The resulting speculative lending weakened the entire financial system. The railroads were built on mountains of debt that demand couldn't support, directly triggering the severe economic depressions of 1873 and 1893. Fast forward to 1996. After the U.S. rewrote its telecom laws, capital poured into the sector to build out the early internet. Companies buried $500 billion worth of fiber optic cables under oceans and across continents. When the initial height sated, reality caught up. 85% of that buried fiber sat entirely unused. Bandwidth prices collapsed by 90%, the Nasdaq plummeted, and thousands of investors were bankrupted. We saw it again in the 2010s with the shale oil boom. Innovations in fracking unlocked massive reserves, and capital rushed in.
U.S. oil production doubled. Supply blew past demand. Barrel prices collapsed from over $100 to about $30, and hundreds of drillers went bankrupt. 3 different centuries, 3 entirely different technologies. In every case, the exact same cycle of speculative overinvestment dictates the outcome. The builders take on the risk, spend the money first, and hope the demand shows up later. That brings us to the second phase of the cycle, the bust and consolidation. Economist Carlota Conraz describes this phase using a concept called the mismatch. When a new technology creates massive potential wealth, the existing economic and social institutions are not equipped to assimilate it. Perez argues that a severe market crash functions as a necessary correction, a required feature of any major technological revolution. But the crash provides a vital silver lining. While the initial investors and speculators lose everything, the physical infrastructure they financed, the tracks, the cables, the rigs, stays exactly where it is. The financial carnage forces that infrastructure into bankruptcy, where it gets sold off at steep discounts. That newly cheap, widely available capacity becomes the foundation for a prolonged period of economic prosperity. If we apply this historical lens to today's AI build-out, we can see exactly where those trillions of dollars are sitting and who is holding the bag. Every computing cycle follows a progression known as IPA. Infrastructure is built first, Platforms are established next, and applications arrive last. Right now, the AI gold rush is trapped entirely in the infrastructure phase. We are laying the tracks and burying the fiber. The only clear winners so far are the companies selling the picks and shovels. We see record revenues for semiconductor manufacturers, data center real estate trusts, and the utility companies providing the raw electricity. Today's tech incumbents have deeper pockets and a much lower cost of capital than the startups of the dot-com era, but they are still absorbing the monumental risk of building capacity without a scaled consumer application to pay for it. By pouring concrete and hoarding chips today, these companies are absorbing all the historical risk, hoping they can somehow outrun a capital cycle that routinely ruins the first movers. So, what happens when this specific capital cycle inevitably turns downward and the infrastructure bubble bursts? If the capital cycle holds true, this level of spending points toward a massive oversupply of data centers and processors. As the supply saturates the market, the cost of raw computing power will plummet. We lived through this exact scenario in the 2010s. Massive platforms like Uber, Airbnb, and Netflix were only possible because they were built on top of the cheap, leftover broadband wiring salvaged from the 1999 telecom crash. The trillions flowing into AI today are effectively laying the heavily discounted permanent wiring for the true economic winners, the future founders who will build the applications of tomorrow.